Hey guys, welcome back to the Loan Officer Leadership Podcast. I am your host, Steve Kiles. And if you wanted to know how to win the appraisal game and what are the 5 things every loan officer needs to consider in today's changing mortgage environment, you are listening to the right episode because I've got a great friend of mine, Alex Massa, with us. Do want to say that we're powered by the mortgage marketing animals. But Alex, brother, I'm excited to have you today on the podcast, man.
Absolutely. I'm excited to share some good information with you guys, and hopefully you can take this and put it in your daily practice.
Absolutely. Hey, well, and if you're listening to the podcast, I really believe it. You hear us say it a lot. Life moves at the speed of relationships. And Alex Massa is not only the CEO of AppraisalMC, which is a national appraisal management company, has been an appraiser since 1999, graduated from University or U of H, Bauer College of Business. His beautiful wife, Tammy, 2 boys, Merrick and Enzo. Brother loves to golf and surf. I can't imagine you doing too much surfing these days. But I will tell you what's really cool. Alex and I have been friends for, I bet 15 out of maybe even more. I've been in the business 20 years. And you and I we became fast friends years ago when we were getting into the business. And man, he's one of the best appraisers I know. And now he's one of the best business leaders running a phenomenal appraisal management company that services, how many states are y'all in now? It's like
33. Yeah,
33 states
right now.
Yeah. And I just got to tell you, I called Alex and I said, hey, brother, there's so much shifting in the mortgage industry. Talk to us about what loan officers need to be doing. But one of the things he's going to do is how do we win this game, the appraisal game? It's such a game with, Alex, I saw a study the other day that said year over year national appreciation, it was somewhere between like 18 to 21.5%. It was nuts. And that just leads me to, okay, well, how do loan officers navigate it so that we don't get caught with not only low appraisals, but how do we make sure we're navigating this market right? So Alex, thrilled to have you, brother.
Yeah, thank you very much. Man, Steve, before we jump into that question, because that's a big can of worms, let's look at what caused this disruption. I reflected this first quarter over the previous 2 years, and so much change in the appraisal industry. For so many years, it was just, going at the normal pace, and all of a sudden COVID hit. And one way to reflect on it is, what was life for an appraiser before COVID, and what was life for an appraiser during COVID, and what is it like today? And this will help us get to your answer. So previously, prior to COVID, if you talk to an appraiser, they could probably on a full-time basis complete 2 orders a day. And the deal flow was very normal, where an appraiser would get solicited 2 orders, they would accept it, and they would go out and do their 2 orders. Well, COVID hit, we all get a little nervous. We don't know what's going to happen. Realtors don't know how they're going to show homes, but they quickly figure it out. And then the Fed decides to lower rates to make sure the economy keeps moving along. So this is a perfect recipe for a boom. And that's exactly what happened. So on a daily basis, pre-COVID, appraisers were getting 2 or 3 solicited orders a day. All of a sudden, now they're getting 15 or 20 solicited orders a day. So the way appraisers worked became very different, and we had to adapt, and we had to figure out, what do we need to pay them for them to accept the 2 or 3 orders that they can do a day, as opposed to the other 18 solicited orders they're getting. So we modified it. We changed our formula. And what we noticed was appraisers were not traveling as far as they typically would. So they condensed their market area. Since they're getting so many orders, it just makes sense for them to be more productive, to accept orders that are closest to their office or home. So we geocoded our entire system and figured out this algorithm that worked best. Second, they're in the business, so fees are important. When you're getting an offer of $800 for a suburban home, and another order comes in at $500, but you can only take one, you're going to take the $800 one. So that was important. The third thing that mattered most was relationships. If you talk to appraisers, they were not adding new clients. They couldn't even service the clients that they had. So you had to have pre-established relationships with appraisers prior to COVID in order to get work done. And that's where we excelled. To answer your question, this is more about values and how are appraisers dealing with values. And this is a very tricky thing to explain for appraisers, because we know the definition of market value is a willing buyer and a willing seller. And in a perfect world, that would work. However, we're dealing with an appraisal that's got rules and guidelines. And those guidelines are given to us by Fannie Mae, Freddie Mac, FHA, VA, USDA. And they pretty much all point to the same thing, which is you've got to have closed sales and closed support for your value. So when the market's appreciating that quickly, it becomes very difficult to capture that appreciation. With that being said, how do you capture that appreciation? Well, we've seen it. People are just paying the difference. They're offering over ask, and they've got so many offers on the table. People will pay cash for the difference, the delta between the appraised value and the sales price. People will just forget financing altogether and just pay cash and get it done with. As that happens, new comps are created and the market starts to move. There are also other metrics we can utilize to make time adjustments for increasing markets, and appraisers are looking at that very closely right now. So I hope that's the long-winded
No, I mean,
version.
that's phenomenal.
Question.
Now, hey, when you talk about time adjustments, do you mean like, and I'll give you an example. There's someone in our local market that I know literally put their house on the market here locally, and same day it went on the market, they were already over list price. And so appraisers are actually considering how fast it goes under contract. Is that something that is a consideration in values as well?
No, it's a little bit different. What we're looking at is historic data over a 12-month period.
Got
and
it.
how much it's increasing over that 12-month period. So if we start using sales that sold, for example, 11 months ago,
Yep.
and the market's appreciated 10%, then we take that percentage and apply it to that older sale. Not necessarily how fast something goes under contract, because when I look at MLS, if you're in a good market, which just about everyone is because of the shortage of supply, everything's going under contract quickly. So
yeah. Hey, and what are some of the things, I want to talk a little bit about, what do you think are the things that loan officers, so this entire podcast is designed, I mean, we've got so many great loan officers all over the country that are listening to this, and they're saying, Alex, you're one of the best, not only appraisers, but now run one of the best appraisal management companies in the country. You're seeing this on a day-to-day basis. What are the 5 things we need to be prepared for? Or what are the things that we need to be looking at to help our buyers, to help our realtors, to help our teams, to help our business continue to move forward? So what would you say the 5 things are?
Yeah, let's start with number 1, which is looking at your process. Most people are working as a broker or mortgage banker, and the bank or the AMC has a certain process of how things are ordered, and looking at that process and making sure that it's done well. I'll give you an example. We had one of the top 10 largest lenders reach out to us beginning of last year. They had an internal appraisal desk, and they just could not handle not just the volume, but they really didn't know how to order in certain market areas. They didn't see the shift and the change that we saw in appraiser behavior. So because we did that geocoding, because we have an algorithm to pick the best appraiser, our system works better than an appraisal desk that had 3 times as many employees as we did. So it's all about the process. So looking at your process first, talking to the owners of your company, if you've got an order and it's not accepted right away, what's the process to get it accepted quickly? Is it just going to bounce around from appraiser to appraiser? How do you get that order picked up? That's question number 1. And then question number 2 is look at your fees. Appraisals are not commodities. Every appraisal is different. Every appraisal has its own complexity, and understanding which appraisals are complex and what really reasonable fees should be will also help orders get picked up quickly. I'll give you an example. If you've got suburban home in a metro in Texas, you offer an appraiser a $500 fee. If it's an easy appraisal, you should get it picked up within 2 to 4 hours if you've got a good appraisal panel. If you've got a manufactured home out in the boonies and it's on 6 acres and it's FHA, you have to understand that only a small percentage of appraisers will actually do that type of appraisal. So your pool of appraisers is limited, which means you've got to give them a much higher fee for them to pick that up. So that's, I think that's question number 2. I saw you take it off mute. I know you have a question regarding fees.
No, no, no. I actually don't, because I think, that it's a changing market, and I think, man, it's in some areas, it's like the wild, wild west. I know we had one in our Florida market, and literally they ordered it. And in order to get it back in time, it was almost $1,800.
Yeah.
And, it's just, you got to be aware that in certain markets, it may be more expensive, or if it's a unique property, or if it's high square footage. But that's where it's great to have a partner like you, where you can literally make a phone call and say, hey, give us an idea of what we're looking at. So that's great.
Yeah. And one thing just to follow up on that is understanding what type of appraisers, what licenses are needed in order to complete assignments. And I'll give you a perfect example. FHA assignments and properties over $1 million can only be completed by certified appraisers. So what does that tell you? That tells you that your pool of appraisers gets condensed even more. Certified appraisers are busier, therefore they're going to be a little bit more expensive. So looking at your FHA fees, your jumbo fees is super important. I'm going to go on to the next one, Steve.
Hey, can I just ask you one thing? Do you
Sure.
think that'll settle down in the future, or do you think this is the new norm with fees?
I think appraisers are going to ask for high fees as long as they can, but eventually it's going to have to settle down. And I think it's just like the value of homes. This is a scarcity issue, a supply and demand issue. And I think once the supply and demand evens out a little bit more, you're going to see, fees get back to somewhat normal.
Yeah. Hey, and talk about this. You and I have personally talked about this in the past. And it has to do with literally the supply of appraisers. Like, there are less and less people becoming appraisers, which in and of itself means that there's fewer and fewer people to accept those orders, which of course is going to drive the cost up. Aren't there, you have any, what the numbers are, like how many appraisers are joining
Absolutely,
our industry?
Yeah. This will shock you.
It's nuts.
This is crazy. When I started in the business in the late 90s, there were 120,000 appraisers.
Okay.
Currently, we've got about 80,000. And of those 80,000, that includes commercial appraisers and appraisers like myself that are no longer in the field. We're running AMCs or other appraisers that are running appraisal desks. There are only 40,000 appraisers completing residential properties
in the whole U.S.
Across the whole U.S. Yeah.
Wow.
This is another crazy stat. In I think it was 2019.
Yeah.
In the entire US, they only added 200 new appraisers, 200 new licensed appraisers.
Wow.
Yeah.
That's shocking, man. Well, it gives perspective too. And I think we need to know what's driving the shift so that we can lead our people well. And that's the key. We've got to lead well. Okay, great. What's number 1 is process. Number 2 is what?
Number 2 is process. I'm sorry. Number 2 was fees. I'm going to go on to number 3.
Okay, cool.
And this is number 3 is allowing qualified appraisers to complete orders. And what does that mean? So if you look at Fannie Mae's guidelines on conventional loans under $1 million, they allow you, Freddie and Fannie allow trainees to do the field work. So basically an appraisal, the appraisal process is you have an appraiser go out in the field, gather the data, measure the property. They come back and write up the report. Fannie allows trainees to do that work. However, so many investors would not allow that. They want the actual appraiser that's signing the report to complete that. And that's what's continually made the addition of new appraisers more and more difficult. If the appraiser that has to sign the report has to do all the work, then what's the purpose of hiring a trainee? So understanding and allowing qualified appraisers to do the work, trainees to do the field work, trainees to do as much work as possible will expand the industry and therefore help turn times and fees get back to more normal process. So going on from that, the fourth topic is aligning with investors that do allow this flexibility. We reached out to many of our clients to find out, hey, do you allow trainees to do field work? And for the longest time, they're saying, no, 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 no. And finally, they pushed on their investors during COVID to allow it. But at that point, it's too little too late. You've got appraisers that are being a little bit more careful. They're not hiring trainees because they were being they weren't working in an office environment. So it was too little too late. But aligning yourself with investors that do allow these flexibilities is my fourth topic. And
awesome. Yeah. And what's number 5?
Number 5 is communication.
Okay.
You've got to communicate with your AMC. And I see this on a daily basis where, we'll give you, let's say, for example, Steve orders an appraisal with us and you need it within a certain time frame, but I cannot find anyone within that time frame, or I can, it's just more expensive. So what my team is going to do is they're going to send out quotes and they're going to send you 3 options. Say, here's an option, it's a little bit more expensive, but it meets your due date expectation. Here's option number 2, it's a little cheaper, but it's past the due date that you need. And then option 3. And we won't hear, not you in particular, Steve, but other clients, we won't hear from them for 3 or 4 days. And that's 3 or 4 days that we've lost in selecting the appraiser. And now the due date is passed. So it's communication and having a team member on top of ordering the appraisal and communicating with the AMC so we can proceed and move forward. I think that's step number 5 is so important in this industry. You do it with your referral partners. You should do it with your vendors as well.
I love that. Hey, and if you're listening today, that's really a great message to get to your loan partners as they're making these order outs, that the communication is absolutely critical. Hey, and talk to us about this, Alex. I want to focus on how can loan officers help? Is there something that a loan officer can do? Like, how do we coach our clients? Like, what are we talking about when we know we're going after a home? Let's say, I'll just give you an example. You got a house that was listed 400. They had an offer 450 or 435 to get it. And we know it was multiple offer situation. What would you have loan officers talking to clients about, talking to agents about? Are there things they can do to help? What are some of the things in that area?
Steve, you know as well as I do that your offer's got to be competitive. And how do you compete with other people in the industry? You've got some people that are offering cash. And if you're offering more, but you're offering maybe a quicker close, that might be an option. So one thing that we've done with a few of our, we've beta tested this with a few of our clients in certain markets, is a 10 or 15-day close, where you'll order the appraisal on a rush. We'll get it done within the 5 or 6 business day period, and you're able to close within the 10-day period or a 15-day period. That makes your offer just a little bit more competitive in the market. That's what you got to do. You got to differentiate yourself in order to get these orders. I see loan officers trying new things. I see companies trying new things where they're actually buying the property themselves, leasing it back to the person that wants to buy it until they can refi or buy it from that company. You just have to figure out, you have to think outside the box.
Yep.
You have to think about what's going to make you competitive.
Hey, and listen, this is such a funny thing. And I've heard this be said, you and I've talked about it. I think last month we did a mastermind together, and it's funny. Tell our listeners, how does an appraisal come in $1,000 to $5,000 under what the sales price is? I always get that. I'm like, Alex, how in the world, like the house was appraised for, $389 and it should have hit, $390. And I'm like 1,000 off. And you and I giggle about that because it happens. You're seeing that they're off by 1,000 or 3 or 5. And then we got to go back to an agent and say, listen, they pushed every bit they could get to that number. They could not find another $1,000. Talk about that.
Yeah. it's a
Isn't
tricky
that always funny,
situation.
man?
Yeah,
It's
it
just
is
like,
always
oh,
fun. And I listen, I was expecting the hard questions too. And this is, I can answer this. So I'll give you an example that I had when I was in the field. I was doing a new construction starter home. And this type of starter home, they have no options. It's the same floor plan over and over again. They have 3 floor plans in the neighborhood. So it was selling for 160, and every single home in that development that was the same floor plan had sold for 159. And I'm going to go back to the rules, right? The rules are you've got to have sales that support the value. There's no proof of an increase in the market. At least at that time, there wasn't. This was 5-6 years ago when I was in the field. So technically, the highest I could appraise it was 159. And I'll tell you, like the psyche of an appraiser, we have a copy of the contract, which is great because that gives us a target. And not that we're going to do anything that we shouldn't do to hit that target, but we understand that there are 2 parties that came together and this is the target. Now, we're going to do everything we can to be able to prove as high as we can and still support it in the market. I've got to be careful with what I say there. You still have to support it with what's in the market. So a lot of times when we're 1,000 or 3,000 or 5,000 short, we've stretched it as much as we can to get it as close as we can. So it's not an appraiser being a jerk and, oh, well, I just don't want them to get this deal done. We're trying to push it to get it as close as we can prove in order for y'all to negotiate. And right now, like, there's no negotiation, right? There's so many offers like, hey, we're just going to have to pay this 1,000 or 3,000 or 5,000 or we're just going to have to figure it out.
Well, and it's so funny because it's the pressure we feel as loan officers because here's the agents. They say, I cannot believe your appraiser couldn't hit that 1,000. And then we're saying they've done everything they could to get that close. And it's this constant tension. And man, it's just always so funny when that happens. Hey, let's talk about this practical side. When somebody's using or they're buying homes, how far back are y'all looking in sales? Because we know, if year-over-year appreciation is in the teens and in some cases low 20%, I mean, it's anywhere from low side, maybe 13, high side 21. How far back are you going? Are you going 3 months, 6 months, a year? What does that look like?
Yeah, so every appraiser is going to attack each property differently. The most typical guidelines, although you can go beyond this, is 12 months. And you're looking at sales within the 12-month period. In order for us to get the most current value, current market data, what most appraisers are trying to do right now is trying to find the most similar sales sold within the last 90 days. And what I'm seeing a lot is appraisers putting at least 2 sales that have sold within the last 90 days. And if there's an older sale, time adjustments are made if it's warranted. So 3 sales are what's required. If you look at most appraisal reports right now, you're seeing 4 to 6 sales. It's just the market that we're in. Again, it's 12 months, but we're going to look for the most recent sales. We have to find the sales that are locationally and physically the most similar.
That's it.
And yeah.
Yeah.
That's
hey,
not
well, hold on. That's
recent.
a big piece right there because you and I mean, hours of conversations around this. Like, it's interesting because, and this is the pain that loan officers are going through right now. It's, hey, yeah, but there was a comp that was 2 blocks over instead of a comp that was 2 doors down. And agents want to cherry pick the one that was 2 blocks over and look over the one that was 2 doors down. And I'm not saying that negative against our agent partners. They're looking for highest value comps. Talk about that. When you're an appraiser and you're looking at comps, you have to use the closest and similar in proximity. You can't just skip over them and go to one that's 2 or 3 blocks down.
Yeah, correct.
Huge. That's a big deal.
Yeah, absolutely. And it makes sense. When you're looking for comparables, you're looking for the most similar properties, right? One thing an example I'll bring up, we had an appraisal ROV, reconsideration of value, come in the other day, and the appraiser had utilized sales from the subdivision. Certification number 7 states that you've got to use the sales that are locationally and physically the most similar. Most likely, those are the ones from your subdivision. 2 or 3 blocks over, you jump a busy street, you jump into a different subdivision, and those price points are higher. And that's where the agent pulled comps from. And that's what we have to discuss right here is locationally and physically the most similar. Is it Is it right to stay within the subdivision in that price point, or is it correct to cross a busy street, go into a different subdivision that's a much higher price point? And underwriters, lenders, they want the most comparable sales. That's what we're
Yeah.
supposed to do. So,
Dude, I mean, that's a great point. Hey, and let me ask you this. What do you think about with AI? Where do you think all that's going? I mean, are you guys talking
yeah,
about, because on some of the automated findings, you can do, waive your appraisal. I mean, there's all kind of stuff happening. Talk about that. What does the future look like for appraisers in the next 12, 24, 36 months?
sure. It's all risk-based. Ever since I started in this industry, I've been told that we would be replaced by an automated valuation model. And here we
Sure.
are, like, busier than ever.
Yeah.
Now they are getting better at it, but Zillow is a perfect example why an AVM doesn't work. Like, their whole model of buying homes was based on an AVM that they built, and it wasn't sustainable. So I think there is a place for it. I think it's all based on risk, right? If someone's putting 50% down and you've got data to support that this property is worth what they're paying for it, why do you need an appraisal? I don't know. I still think it's an insurance policy for the buyer. Appraisers are measuring the property and they're verifying that everything that's listed in that MLS and tax record is correct. I would still get one. It's just such a low cost insurance policy to make sure you're getting what you're getting. But there's a place for an AVM. There's a place to mitigate risk. And if it's low risk, it should be an option.
Yeah. Well, and I do, man, it's so funny because you hear that every few years. Realtors are going to be replaced. Loan officers are going to be replaced. Appraisers. And the reality is there's so much complexity to what we do that I think there's a lot of job security for the ones that will continue to grow, do it right, stay focused on the daily success plan. And man, I just think there's an amazing opportunity. Carl and I were talking literally last week, and next year's projected to be the highest purchase money year ever in history. And the year after that is projected to be very similar. And so even though, like, you're just seeing all of this phenomenal growth in our industry now, refis have gone away, but they're not completely gone. You still do cash outs and there's opportunity, but man, the purchase money market is exceptional. Hey, let me ask you this. Alex, as when you're saying, what do you think are the biggest challenges loan officers are going to face this year around appraisals? What are some of the things we need to just be thinking about?
I think the challenges are going to dwindle. I think you're going to have less challenges. I think people are starting to figure out how to maneuver in this process. There's still markets that are very, very busy. But people like myself and other very smart individuals, much smarter than I, are coming up with solutions. Fannie Mae and Freddie Mac rolled out a desktop option, although it's not 100% viable right now. I think it will become an option in the future for quicker and maybe less expensive appraisals. We'll see. Technology is going to have a piece in being able to make this process a little bit better, but this is still a relationship business, right? Yeah. And that's what real estate is. It's a relationship business. Although technology can help, if you don't have someone on the back end pushing things through, you, for example, quarterbacking a loan from start to finish, myself quarterbacking an appraisal order from being ordered to being received, reviewed, and sent to the lender, without people actually doing that in the process and having the relationships with realtors, having the relationships with appraisers and building that rapport, you're not going to have a successful business. So I think as long as you align yourself with, people that are continuing to expand on their relationship, you should have less problems here going in the future. I think you'll have less problems with fees. You'll have less problems with turn times, just with the volume dwindling a little bit.
Dude, I love it. Hey, well, Alex, man, thank you so much for jumping on this quick podcast just to shed some light. I'm hearing so much about appraisals and appraisers, and could you have somebody come on and talk to us a little bit more? And so, brother, I just appreciate your friendship over the last 15 to 20 years, man. You're remarkable. And we love working with you, man. You got a great group at AppraisalMC. If you want to learn more, check them out. AppraisalMC, they're a great management company, really solutions oriented, 33 states. So, brother, I appreciate your friendship. Thank you for being on the podcast.
Thanks, everyone. I hope you have less appraisal issues this year, and may values be hit.
Yeah, there we go. Hey, well, listen, if you're listening today, I want to encourage you a couple of things. One is, man, if you'd love to learn more about the daily success plan and a consistent, same way every time sales process, what do I do on Monday, Tuesday, Wednesday, Thursday? We would love to help you build a strategy plan. It's a blueprint to how to grow over the next 12 months. And then what do I need to do to take action in the next 90 days? Go to freedomplanningcall.com, freedomplanningcall.com. We'd love to get you with one of our great people, Mike and Erica and Ralph, and literally help you build a plan to continue seeing great success here in this year. Hey, and one other thing, I wanted to give a quick shout out to Heather E471. She gave us a review wherever you consume podcasts. This was on Apple, literally just a day ago, gave us a great review. Heather, thank you for what you had to say. Heather E471, she said, level up. I'm a new loan officer. Listening to this podcast has really upped my game. I feel like I'm better prepared to speak to clients and work through their objections. I'm obsessed with the scripting podcasts. Please keep them coming. And so just wanted to say thank you, Heather, for your review, honest review of the podcast. Really appreciate it. If you're listening today, would you give us a review? It helps us in the rankings, helps it get the word out. And then also remember to subscribe and share this with 2 other loan officers that you know that would benefit and may have questions about appraisals. So want to thank you for being on the journey. Make sure if you haven't done your strategy call, book that at freedomplanningcall.com. And then we'll see you on the next episode. Remember this, anything worth doing is worth doing badly. Just get started. See you.